Today we look at the latest developments in the U.S. economy, from unexpectedly strong GDP growth to falling jobless claims and declining consumer confidence. These trends might seem contradictory, but together they paint a deeper picture of where the U.S. economy is heading and what it means for markets and everyday Americans. We'll break it all down clearly, step by step. In the third quarter of 2025, the U.S. economy expanded at an annualized rate of 4.3%, far exceeding economists' expectations of around 3.2%. This marked the fastest pace of growth in 2 years, boosted by increases in consumer spending, exports, and government expenditures. But this robust growth comes with a twist. Many Americans still feel economic pressure, highlighting a gap between headline GDP numbers and real-world financial stress. This week, U.S. weekly jobless claims unexpectedly fell again, dropping to 214,000 for the latest reporting period. Falling jobless claims often suggest fewer layoffs and continued labor market resilience. However, deeper employment data shows a complex picture. Although layoffs are low, hiring has softened, and the overall unemployment rate rose to around 4.6%, the highest in 4 years. This low-hire, low-fire pattern indicates businesses may be cautious about new hiring, even while avoiding mass layoffs. Despite strong GDP and falling jobless claims, American consumer confidence has declined for the 5th consecutive month, reaching its lowest level since April. Consumers reported increased concerns about high prices, tariffs, and job prospects, even as inflation shows signs of cooling. This disconnect, strong macro figures but weak sentiment, highlights a growing sense of financial caution among households. U.S. stock markets have reacted positively to recent data, with major indexes such as the S&P 500 and Dow Jones hitting record highs. This Santa rally reflects optimism about potential Federal Reserve policy easing, strong corporate earnings, and resilience in certain sectors like technology. But investors must balance upbeat market performance with the underlying concerns in the labor market and consumer sentiment. So why does the economy seem strong on paper, yet uncertain on Main Street? Economists point to several structural factors. GDP measures total output, not distribution of income. Jobless claims show layoffs, but job creation remains weak. Consumer confidence is shaped by everyday costs, like housing, food, and healthcare. The result is a complex performance, where headline numbers might look solid, but many households still struggle to feel economically secure. Looking ahead, analysts forecast continued moderate growth, persistent inflation pressures, cautious hiring potential impact from global policy uncertainty. Major central banks, including the Federal Reserve, have engaged in significant rate cuts this year, but future monetary policy decisions will depend on how inflation and jobs data evolve. For investors, this means navigating a landscape of mixed signals: strong GDP, cautious labor markets, and uneven confidence. In summary, the U.S. economy shows resilience in some areas and softness in others. Consumers remain cautious, companies are selectively hiring, and markets are optimistic. Understanding these trends is crucial as we move into 2026 and beyond. For clear, fact-based explanations of major U.S. trends, subscribe to Federal Brief Network. Thank you for watching.